everyone, welcome to another video. Today we're going to talk about why your bank increase the mortgage rate and why your bank sometimes decrease the mortgage rates. Please like and subscribe this channel to get these types of housing market insight. So thank you very much for watching. Most of the Canadian they understand and well familiar with the two types of market. One is the variable mortgage rate, another is the fixed mortgage rate. So the question is that one. So why the variable mortgage rate is up or down? So variable mortgage rate is basically indicate that the interest rate that's vary from month to month. So the bank that offer the variable mortgage rate that's depend on the policy rate of Bank of Canada. You also aware that Bank of Canada they announce the time to time interest rate, policy interest rate, and based on this policy interest rate, the variable mortgage rate that offered by your bank also ups and down. Now you might be asked questions why the policy interest rate is ups and down by the Bank of Canada. That also depend on the inflation rate and other factor as well. We put down the other factors here. For example, unemployment rate, population growth, exchange rate, government and private spending, and so many other international factor that are associated with the inflation rate. That's then the policy rate also depend on the inflation rate. Interested, you can see here that they're ups continuously, they're up and down time to time their policy rate, and based on the policy rate the bank they change their variable mortgage rates. Now if you come to the fixed mortgage rate, so fixed mortgage rates, that means it's fixed for a period of time that you make a contract with your bank. It may be 1 year, it may be 3 years, it may be 5 years as well. So how the fixed mortgage rate depend? So the fixed mortgage rate that's offered by your bank at the time of your renewal or your loan, this depend on the government bond market, and government bond market rate also depend on many other factors as well. So if you look at the Bank of Canada bond market, so you can also find that the bond market 1 to 3 years or 5 to 10 years or other bond markets that are ups and down. So the fixed mortgage also ups and down the time that you make a contract with the bank. So that is about the interest rate, how it is determined in the market. Let me know what do you think about how the other factor that's depend on the interest rate and affect the variable and fixed market. So let me make comments in the below, and thank you very much for watching. Have a nice day.